Right now, somewhere in the United States, someone is quietly paying more than they should for a car, a credit card, and even their home. Not because they made a bad financial decision on purpose, but because of a few small credit score mistakes they don't even realize they're making. The scary part is not the mistake itself, it's what happens over time. A slightly higher interest rate today can turn into thousands of extra dollars tomorrow. Month after month, year after year, money leaves their pocket and goes straight to the lender, all because of a number most people only think about when it's already too late. In this video, I'm going to walk you through 5 hidden credit score mistakes that quietly drain money from everyday Americans. These are not the obvious ones you hear about all the time. These are the small, easy-to-miss behaviors that can slowly pull your score down without triggering any alarms. And at the end, I'll give you a simple 24-hour action plan that can help you start fixing these problems immediately, even if you've never looked at your credit report before. Your credit score is more than just a financial grade. It's a silent decision maker that follows you through almost every major moment in your adult life. When you apply for a car loan, your score decides how expensive that car really is. When you apply for a credit card, your score decides whether you get a low interest rate or a high one. When you apply for a mortgage, your score can quietly add or remove tens of thousands of dollars from the true cost of your home. Most people focus on their income, their job, or their savings, but lenders often focus on one simple question: how risky does this person look on paper? That's why even a small change in your score can have a massive impact on how much you pay over time. A difference of just a few points can mean the difference between being approved instantly and being denied, or between a fair rate and a painful one. The first hidden mistake is something most people don't think about at all, even though it's one of the most powerful factors in your score. It's called credit utilization. This is simply how much of your available credit you're using at any given time. You might be paying every bill on time, you might never miss a due date. But if your cards are close to their limits, the system still sees you as financially stressed. To the scoring models, high utilization looks like someone who is relying too heavily on borrowed money. Even if you're responsible, even if you plan to pay it off next month, the snapshot they see right now can work against you. A good rule of thumb is to keep your usage below 30% of your total limit. That doesn't mean you need to pay off everything. It simply means creating breathing room. The powerful part is how fast this can help. In many cases, making a small payment today can start improving how your profile looks within weeks, not months. The second mistake is trusting your credit report without ever reading it. Most people assume that if something is on the report, it must be correct. But mistakes happen more often than you might expect. Accounts get mixed up. Payments get marked late when they weren't. Old balances stay on the record longer than they should. Each of these errors can quietly lower your score, and because they don't trigger any obvious warning, they can sit there for months or even years. What makes this especially frustrating is how simple the fix can be. In many cases, disputing an error is just a matter of filling out a short form and attaching a document. It's not exciting. It doesn't feel like a big financial move, but it can be one of the fastest ways to remove unnecessary damage from your profile. This one surprises a lot of people because it feels like the responsible thing to do. You stop using an old credit card, so you close the account. Fewer cards, less temptation, cleaner finances. but to the credit system, that can actually look like a step backward. One of the factors in your score is the length of your credit history. The longer you've successfully managed accounts, the more stable you appear. When you close your oldest account, you shorten that history in an instant. Even if you never use that old card, keeping it open can quietly work in your favor. It adds to your total available credit and helps show a long track record of responsible use. Sometimes the smartest move isn't doing something new. It's simply not undoing something old. Every time you apply for new credit, a hard inquiry is added to your report. 1 or 2 is normal. You're shopping for a better card, a better loan, a better rate. That's part of being smart. But when too many inquiries appear in a short period of time, it sends a different message. It can make lenders think you're under financial pressure or desperately seeking credit. Even if that's not true, the pattern alone can make your profile look riskier than it really is. Spacing out your applications and being intentional about when you apply can help keep this part of your record clean and calm instead of crowded and chaotic. The final hidden mistake is having only one type of credit. To the scoring system, variety matters. Credit cards show how you handle revolving credit. Loans show how you handle long-term commitments. Together, they paint a fuller picture of your financial behavior. Someone who manages both responsibly often looks more stable than someone who only uses one type, even if both people pay on time. This doesn't mean you should go out and open accounts you don't need. It simply means understanding how your overall profile is being interpreted and planning your financial moves with that bigger picture in mind. Here's a simple plan you can follow in the next 24 hours. First, check your balances and pay down at least one card below 30% of its limit. Second, pull a copy of your credit report and scan it for anything that looks unfamiliar or incorrect. Third, pause on any new applications you are considering and give your profile some time to breathe. And finally, take note of your oldest account and make sure it stays in good standing. These steps don't require special tools or advanced knowledge. They just require attention, and over time that attention can translate into lower rates, better offers, and more financial freedom. If you want more simple, practical guides on using smart systems and modern tools to take control of your money, subscribe to this channel. Every week I break down real strategies that everyday Americans can use to save more, stress less, and build a stronger financial future, one small decision at a time.